to begin.
Okay, thanks, Paul. Thanks for the introduction. Nice to be back and very happy to present with Tom on this paper. Let me just share my screen, which I hope is working. Um, and thanks to Louise in the background for organizing things as well, and to the NERI for the opportunity to contribute to the series. The title of the paper from Tom and I, we're going to split the presentation of this afternoon, is Taxation and Intergenerational Fairness, exploring the role and reform of inheritance taxes in Ireland. And we're going to look at this kind of over 6 bits. So a quick introduction from me, and then we'll take a look at household wealth. That kind of leads in then to an exploration of the economic and social rationales for and against inheritance taxes. That kind of triggers some design considerations quite broadly, and then we move those on to think about in the context of Ireland and inheritance taxes and reforms to enhance fairness around those and then a conclusion at the tail end. Out of interest, this is based on a recent paper that Tom and I published in a special edition of our special section of the Social Policy and Society journal. They did a section focused on fairness and distributional outcomes, exploring the role of taxation. And then within that, we contributed a paper looking at fairness around wealth and inheritance taxes. There were other papers on environmental sustainability, on social need, on tax expenditure in that special edition too. And as we talk, Louisa will put in the link to that paper. It's an open access paper. In other words, it's free to access for anybody who wishes to, and that link is there for anybody who wants to follow up on the kind of detail of the paper, which we've put in there as well. I suppose as an introduction to this, we've kind of ended up in quite interesting space with wealth data, where there is new and recurring data on household wealth that has begun to appear over the last couple of years. We'll talk a lot and use the European Household Finance and Consumption Survey collected across all the Eurozone countries. That's had a couple of rounds and kicked off for the first time in 2010, and kind of at a European level was our first real set of robust recurring understanding of what household wealth is and what household wealth has looked like. And actually, when you kind of go outside Europe to other parts of the world too, there's kind of a similar, Europe is sort of ahead of some parts, behind others, where you have begun to see more recurring household surveys that are gathering robust data on wealth. I suppose actually when I kind of think about it in the context of my own experience in kind of where economics meets social policy, I would say we're kind of at a space where for social policy, which is the journal focus we were writing to, but for kind of socioeconomic policy and taxation policy, in fact, we're at a place where income data got to in the 1990s. Income data up to the 1990s was quite rare. And kind of only occasionally appeared. Then it became recurring and annual from the 1990s onwards, and we kind of take it for granted now as we begin to look at and think about what might happen to different things on the back of recurring income data. Well, wealth is very much now into that space that income got to in the 1990s, which has kind of really interesting implications for how, for I suppose, opening up greater engagement on issues around what wealth is, around what wealth looks like, around the composition of wealth, and kind of related questions, obviously linked to things like taxation and so on that we're going to talk about here. We talk about in the paper, in effect, as something where we've moved from a kind of abstract engagement with this issue So, there was and there is a literature predating all of this data to a point now where it's more applied, where in fact the data is more detailed, where the data is recurring, where we can see changes, we can understand it, we can link it to other household characteristics and so on, and that allows us to have a much more comprehensive understanding and engagement on these issues, and very relevant for the kind of policy space that we're thinking about and looking at today as well. I suppose in there that includes issues about intergenerational transfers. And as we'll see when we look at this wealth, there are clear issues about the scale of intergenerational transfers that are about to happen over the next 2 decades or so, and that throws up really interesting issues about how we, as society, should understand that and handle that. And to a great degree, we can see it coming, so we should begin to think about it, and we should begin to plan for it. The aim of the paper for the journal was reflecting the aim of the sort of special edition of that journal, which is to try and link, a very economics literature around, and perhaps taxation literature, but much more so economics literature around taxes and inheritance, to a kind of social policy slash public policy space where we begin to think about the consideration of these issues and their distributive implications, and so on as well. And we think about those reforms in with using Ireland as a case study for all sorts of reasons. Clearly, Tom and I, as the authors of the paper, come at it from an Irish perspective, so that helps. The report of the Commission on Taxation and Welfare a few years ago, had two kind of interesting recommendations. Its opening recommendation was that, well, if I can paraphrase it, was that inevitably there needs to be an increase in recurring taxation to the state, and the state therefore needs to figure out where it's going to get those resources into the future. And then later that report has a number of recommendations in which we'll come back to, on inheritance taxes and so on, wealth taxes, and they're kind of really about reforms in that space to make wealth taxes fairer, and so that they would contribute more to the, by broadening the tax base to the tax that's collected. And then the third context is obviously that there's wealth data, and the Irish wealth data is there. We're going to use that predominantly comparatively for our work here, as we set it up by comparing it to other European countries. And what's wealth? It's what are we talking about there for? It's a stock, whereas income is a flow. So they're not the same thing. So we're talking about the stock of wealth, and in fact, when we're looking at this here, we're talking about the stock of net wealth, which is the big focus that we have, and the literature has, and our kind of understanding of wealth overall tends to have. So net wealth is gross assets minus liabilities. If you own a house which is worth 400,000 euro, and you've got a 300,000 euro mortgage remaining, well, your net wealth is the bit that you own, which is 100,000 euro. So it's taking away the liabilities from the assets to give us what people actually possess, and so on across all the different areas of wealth, which I'll come back to in a second. So we're going to focus on net wealth, as the literature does. Various kind of different descriptions of asset types that appear. We're going to talk predominantly about real assets and financial assets, which is the way in which this data is presented. But you'll see them referred to in different ways. Of course, different assets have different kind of characteristics. Some are mobile, some are immobile, some are liquid, some are illiquid or less liquid at least. And you'll see that we can think about that as we look at them as well, which clearly has implications, design implications, when we might be thinking about some of the tax measures as well. And there's numerous categories, which I'll come back, there's a small list there, but I'll come back to them on a table in a second to look at them. But when we look across the countries that we're looking at here, countries across the Eurozone, won't surprise you that the household main residence is really the predominant area of wealth for most households. It makes up over half of all household wealth when we look across the Euro area. So in fact, often, a lot of the time when we're talking about intergenerational transfers, it's intergenerational transfers of household main residences that tend to arise as very big issues here. Although, as you'll see from the data, that's not the only thing going on, and that does throw up some important distributive issues, which we'll come back to when we're talking about it. If we take a look at the data that's out there on household wealth for our paper, we have used, as I've mentioned, the European Household Finance and Consumption Survey data collected by the national statistics agencies in conjunction with the European Central Bank across all the Eurozone member countries. They do it every couple of years. So the latest comparative data is for 2021, which was for 22 Eurozone or Eurozone applicant states. And there's been data collected since, which I'll come back to, which hasn't been released in a comparative format just yet. But for the paper when we wrote it, it was for 2021. Again, focused on net wealth. I suppose if you look at, and we briefly describe it in the paper, the kind of descriptive statistics on that, just looking at them in a quite kind of raw way, higher net wealth is associated with larger households, with households where there's higher completed levels of education, with home ownership, unsurprisingly, and with employment as well. And clearly, often those characteristics are correlated as well. If we look at it across the age distribution, there's a humped-shaped pattern to that as well. Wealth accumulates, and then across retirement, wealth begins to decrease again. We have a few tables in the report which kind of set out, sorry, in the paper which set out what wealth looks like. This table one looks at the participation rates and then the composition of wealth across all of the Eurozone countries. So if you look at the way it's broken down into real assets and financial assets. So real assets are things like housing and things like other property and so on. And financial assets then things like deposits in the banks, things like shares, things like pensions, and so on as well. So that's kind of the composition of it as it's broken down. And the first column of numbers looks at the participation rate, so the proportion of households that have some of something in each of these categories. And so if we kind of just pick a few things from that table to look at, I'll read from the bottom upwards here. So deposits are held, so deposits in financial institutions held by 96, almost 97%. Sorry, read that wrong. 98% of households, so most households holding that. Vehicles, 78% of households, and households owning part or all of their home, 61, almost 62% of households if you look across the Euro area. And that's kind of where the big levels of participation are. And if we look at the values for those as well, so the final two columns give you conditional medians and means. Conditional means that it's for those who hold an asset that we begin to estimate the value. So of all of those European households who have a household main residence, the mean, the average value is just under €250,000. For other real estate, it's €340,000. And the other big category is self-employment businesses, which is €293,000 on average of value in those assets. So very predominantly, when you begin to look at the structure of wealth, it's orientated towards property, household main residence, and other property, and towards self-employment businesses, which will of course include farms, which we'll come back to as well. And then if we look at the kind of distribution of those resources across European countries. So let me start with Europe and then there's some other countries, including Ireland, underneath. So, how's that spread out across households in society? within the euro area overall, the top 50% of households in terms of their net wealth holdings hold 94% of all of the wealth. If we move further up the distribution, the top 10% hold 53% of the wealth, the top 5% about 40% of the wealth. So we got very concentrated holdings of wealth at the top of the wealth distribution, as you'd expect. P80, P20 is a comparison of how big is the share of the bottom 20 versus the share of the top 20%. That's 33. So the top 20% of 33 times the wealth share of the bottom 20%. So again, underscoring that concentration. And the final figure on that table is a Gini coefficient, which measures the concentration or the inequality in that distribution. That's 69 for wealth across the euro area. And the figures for Ireland at the bottom of that table, all the countries are listed in the paper. I just had a few of them put into this table here. In Ireland, the average wealth was 370,000. The median middle was 193. So that kind of underscores the skewed nature of it towards higher wealth households. And again, the concentration, 92% of all wealth sits in the top 50% of wealth households, half sits in the top 10%, 36% in the top 5%. So quite a concentration of wealth at the top of the wealth distribution as well. And the Gini coefficient, 66.6% there. We're used to hearing about Gini coefficients. We tend to hear about them for income, and we tend to hear about them for the income distribution and the concentration of income in the income distribution. This chart puts the income figures next to the wealth figures. So the income are the black bars and the wealth ones are the gray bars. And so that's kind of just to illustrate how much higher the inequality is or concentration of wealth is relative to the wealth of income in societies right across Europe. In all cases, we're seeing quite high concentrations. Just to finish from my side for a while, just to flag, we stopped in 2021 because that's where it's comparative data. But since then, the CSO last June will have issued this report, the most recent Household Finance and Consumption Survey with data that they and the Central Bank collected for 2023. That sort of shows a further concentration, actually, further increase in concentration of wealth in Ireland as well. So the value of net wealth has increased as house prices have increased, in fact, over that period. So it's now 256,000 as the median value for that. The concentration further reflecting that. So the wealthiest 10% just crossing €1 million in terms of their net wealth compares to the bottom 10% of 2,400 in wealth. So quite big divides when you look across it. And maybe underscoring the household ownership aspect of that, owner occupiers on average, or the median value is 390,000 versus those who are renters, their net wealth was just over 10,000. So again, big divides, and housing as a big aspect of that. And I won't talk to this too much, but you can dig into the CSO report, which will show you the composition across the distribution of net wealth as well. Predominantly driven, as I said, by household main residence. Although when you get to the very top of the distribution, which is the 9th and 10th deciles there, you begin to see other areas of wealth kick in, other real estate, so other property, land beginning to kick in, and self-employment businesses beginning to kick in as well. And so that kind of throws up interesting issues at the top of the distribution around the transfer of those assets, which is a point that Tom is going to come back to and talk about, and I'll hand over to Tom now.
Thank you so much, Micheál. So what I'm going to do is I'm going to talk a little bit about some general tax objectives that we need to be thinking about whenever we're designing a new tax or reforming an existing one or thinking about the overall taxation system as a whole. I'll place the inheritance tax that we have in Ireland in the context of other existing wealth taxes. It falls within that broad family, and then I'll briefly talk about the arguments for and against before describing what inheritance taxes tend to look like in other European countries and in Ireland, and then finally look at some suggested policy reforms before handing back to Micheál. So on the next slide, then, broadly, when we're looking at general tax objectives, we start really with the need to raise a meaningful amount of revenue for the exchequer. As we'll see, wealth taxes in general, of which inheritance tax is one, are broadly a very small component of the overall revenue base of any state. There's really four large taxes: in income tax, corporation tax, social security contributions, and taxes on consumption, mainly VAT. Nevertheless, that doesn't invalidate them. It perhaps suggests a greater ability of wealth holders to use the system to end up with lower taxes than we see on income. But even if we can only raise a few hundred million or a billion here or there, it all certainly contributes to funding the state. Second of all is the notion of horizontal equity. And this is the idea that a person or indeed a group or two groups with the same taxable capacity or ability to pay should be treated equally under tax law, and that they should pay the same amount of tax. One important policy implication that follows from that is that we should really minimize the use of tax expenditures that are available to different persons, groups, sectors, or indeed activities. And this has implications in terms of the different categories we use for the different groups that we tax, and also for the differential taxation of different types of assets. It also implies that inherited income and earned income should not necessarily be treated differently. It shouldn't necessarily matter where the income that you receive comes from, whether it's an endowment that you get because you are lucky in terms of the assets available to your parents, or alternatively, the work that you do and that you earn yourself. A third principle is vertical equity. This is simply the notion that those with greater taxable capacity, i.e. higher wealth and higher income, should bear a proportionally heavier tax burden because they benefit more from the advantages of being in society. They have greater power, greater access, but also that taxing them will have a smaller impact upon their standard of living because they have broader shoulders to bear the cost. Fourth, fifth, and sixth, then, minimizing economic distortions, supporting economic efficiency. This broadly means that we should aim to focus on the types of taxation that will minimize damage to the economy or indeed potentially support the economy. So the costs and benefits of a particular tax ultimately need to be considered against the tax and benefits of other types of taxation, rather than thinking of them purely on their own basis. And then finally, risk of capital flight is probably not particularly significant in regards to inheritance tax, but may be relevant for other types of taxation, such as income tax. And then finally, minimizing administration and compliance costs. Again, here, making the tax as simple as possible is an important policy goal. On the next slide, then, we can just identify that inheritance taxes are a form of wealth tax. Wealth tax themselves are taxes on a stock of assets. Other examples include property taxes, such as the LPT, capital levies, land tax, for example, would also be a form of property tax. The three main types of wealth tax specifically are commonly identified as tax on wealth transfers. In Ireland, that's the inheritance and gift tax, or CAT, capital acquisitions tax, as we call it. Taxes on capital appreciation are the second type. Capital gains tax is what we have in Ireland, although arguably this is not a true wealth tax. And three, tax on net wealth holdings, or a net wealth tax, net household wealth tax, for example. And we haven't had one of those in Ireland since 1978. Although I know a lot of work has been on that recently by Oxfam and other groups. In terms of the next slide, I suppose the case for taxing inheritance can be summed up as you see it on this slide. The main rationale that is usually given is equality considerations. So we can think of equality of opportunity, for example. To be a genuine meritocracy, you have to have equality of opportunity. So if you have a scenario where somebody is inheriting hundreds of thousands, getting a free house, inheriting millions, versus somebody else who does not and is continuing to pay their mortgage into their 70s or finds themselves renting later on in life, you don't have an equality of opportunity. You do not have, and certainly do not have an equality of outcome. Social solidarity is also important here. Horizontal equity, as noted before, in terms of all income should be taxed. And I suppose fundamentally what we're getting at here is the need to temper wealth concentration, because we know that wealth concentration and wealth inequality has a corrosive impact upon the democratic process itself. Differential access of power and influence undermines our very democracy itself. And we can see this in its extreme form in places like the United States of America. But curiously, the inheritance tax is also potentially an efficient tax. What do I mean by that? I mean that its impact on real economic activity is likely to be minimal relative to other forms of taxation, particularly income tax or corporation tax. So there's an opportunity cost argument here. It is more efficient to fund the state through measures like inheritance tax than it is through measures like income tax, albeit inheritance tax will always be a very tiny proportion of overall revenue. In addition, there's the anticipation effect on the recipient. Recipients that know that they're going to inherit have a disincentive to invest in their own human capital. They're less likely to be entrepreneurial because they know that ultimately they're safe. They're going to be protected. So that tends to dull their initiative and their likelihood to be innovative. And then, arguably, inheritance taxes, looking at the different types of wealth taxes, are administratively easier than net wealth taxes because they perhaps only happen on a smaller number of occasions over the lifetime of the person. So a recurring wealth tax might need to be catered for every year, for example. And then finally, inheritance taxes could potentially help in the fight against tax evasion by recording the transfer of wealth through the generations. On the next slide, of course, we have to look at the issue of why inheritance taxes may be a bad idea. One of the most common arguments made against inheritance taxes is that it's a form of double taxation. So, in other words, it's already been paid for through income tax when the wealth was generated, for example. But double taxation really is common to all taxes. So whenever you pay VAT, you are paying VAT out of the income that you have left after paying your income tax or USC. And similar analogies can be made for all forms of taxation. And really the only case where you do not have a double taxation is where there is only one form of taxation, which is obviously a fantasy world. It doesn't exist. And ultimately, what matters is not how many times something is taxed, but the combined effective tax rate overall. Second of all, as an argument against, is the notion of the anticipation effect potentially distorting investment activities. People see that it's going to be taxed in the longer term, and that reduces their incentive to invest in a new business, for example, in the first place. If it's simply going to be lost down the line. Third is that if you introduce a tax and you introduce a swathe of exemptions and reliefs, well, of course, you're going to distort investment decisions. But of course, that means that's an argument against having the exemptions and reliefs, not necessarily an argument against the tax per se, assuming that the actual rate is not set at a punitive level. And then finally, there's the concern that inheritance tax will lead to the breakup of family businesses. But the evidence, albeit scant from the literature on this issue, suggests that second and third generation businesses are actually less efficient, and therefore it may be rational from an economic output perspective for the business to be transferred ultimately or sold ultimately to someone who isn't necessarily connected with the family and perhaps is more dynamic. So we can see on the next slide just how small the capital acquisitions tax yield has been in Ireland, really ranging from 400 to 600 million from 2015 to 2022. That has increased in recent years. It moved up to over 850 million in 2024 and around 1.1 billion in 2025, according to the early figures. But you can see in all cases, it's a minuscule percentage of GNI star, about 0.25%, and an even smaller percentage of household net wealth. So in other words, the effective tax rate arising from capital acquisitions and endowed income is vanishingly small compared to, for example, the taxation of income. So then on the next slide, we talk about some design considerations, and there's been a review of approaches across the OECD. 2/3 of OECD countries did have taxes on inheritances or estates in 2019. A majority of EU countries do. A few countries don't, or half a dozen or so. I think 8 countries at the moment don't. But it exceeds 1% of total tax revenue in just 4 countries. There are progressive rates in a small majority of these countries, rates ranging enormously from 1% to 80% in Belgium at the highest rate. In fact, in one Spanish region, it goes over 80%, and enormously different exemption thresholds, 15,000 in Belgium to over $10 million in the United States. In all cases, effective tax rates are much lower than the implicit tax rates on consumption, labor income, or capital income. In other words, endowed income or inheritances are much more favorably treated than consumption, labor income, or capital income. And we know that close family members tend to receive preferential treatment. About half of countries that have inheritance taxes exempt spouses, about half exempt children, and essentially a majority of estates go untaxed, which partially explains the very low yield in many of these countries. The next slide then looks a little bit more closely at Ireland. The rates originally varied from between 5% and 50%. They've been 33% since 2012. CAT receipts were about 850 million in 2024. That's gone up to about 1.1 billion. As of 2025, the majority comes from inheritances. CAT, of course, has a lifetime tax-free threshold known as a group threshold based on the relationship between the person making the gift or leaving the inheritance and the recipient. The recipient being taxed is common to most EU countries. The UK and Denmark are different in that they tax the estate. Tax-free thresholds vary enormously as well. It's 400,000 for a child, which is Group A, 40,000 for a sibling, niece, nephew, or lineal ancestor or descendant, Group B, and just 20,000 for all other groups. So immediately you can see enormous differences, and it becomes evident that horizontal equity is clearly not a policy priority when it comes to capital acquisitions taxes. Category A amounted to 380 million of a yield in 2024. Category B was about 360 million, and Category C was between 90 and 100 million. There is also a small gift exemption on the first 3,000 received during each tax year. So that's 6,000 if you're lucky enough to have both of your parents alive and wealthy enough to pass it along. There's also a dwelling house exemption where a person continues to live in a home. And as I said, an exemption made between spouses. In addition, there are enormously generous agriculture and business property reliefs, which reduce the market value of the relevant assets by 90%. So in other words, the value of the asset is given 10% of the value. So 4 million would be worth 400,000 and therefore completely exempt. And we know that in terms of the wealth deciles, you'll have seen from Micheál's last slide there that agricultural assets, business assets, land assets tend to be massively disproportionately held by the single top decile. And the value of the relief is very large. The ag relief cost 237 million, over 1,700 claims. The business relief costs 430 million over just 782 claims for an average relief of over 500,000, thereby depleting the total yield ultimately from 1.5 billion to 850 million. So a very, very expensive pair of tax reliefs. We know now that with net household wealth exceeding or being close to about 1.2 trillion in 2024, that ultimately we have an effective tax rate on net wealth transfer, assuming transfer every 25 to 40 years, of somewhere in the region of 1.8 to 2.9%. In other words, very, very low compared to taxation of income, of labor income, of capital income more generally, consumption, and so forth. On the next slide, then, we go back to our design principles, looking at that again. Our view is that tax and wealth transfers are justified on equity and efficiency grounds for the reasons that we've discussed before. They're a potentially meaningful source of recurring government revenue. They're not going to ever generate billions upon billions year on year, but really building up a coherent taxation system is always going to be made up of different Lego bricks of different types of taxation. Broadening the tax base is very, very important. We cannot rely on two or three sources. The system that we have in Ireland and in many OECD countries is appropriate in the sense that it should be on the recipient, i.e. the person benefiting, rather than the donor. Our view is that gifts over the lifetime should be included in the assessment of inheritance taxes. That obviously has implications for the 3,000 or indeed 6,000 that you might get year on year. And that ultimately tax should apply on a lifetime basis rather than treating inheritances one by one or looking at the different donors. It should be a lifetime threshold for everyone, which should be the same for everyone on horizontal equity grounds. So same rates and thresholds for all, avoid exemptions released in favor of above valuations, and there is a case for a progressive inheritance wealth tax rate, as per some OECD states. And in our view, it's administratively simpler to have this as a standalone system rather than combining it with the income tax system overall. The Commission on Tax and Welfare had four main findings, in fact, when it came to inheritance tax. One was that foster children should count as part of Category B and not be discriminated against. But the Commission found that the tax reliefs on agriculture and business assets was much too generous and should be reduced. That the Category A rate should be reduced, and that Category A, B, and C should be brought much closer together, and also that there should be a basic minimum inheritance tax rate that would apply on all inherited income, ultimately. Looking at the next slide, then, we can see from our ready reckoner, which revenue generously provide, that increasing the rate by 1% up or down would yield or cost about 28.2 million. It's not as simple as a straight line the whole way up, but that gives you a sense of the amount that you could bring in or how much it would cost you to reduce it. Reducing the agricultural relief from 90% to 80% would bring in 11.6 million, but dropping it to 50% would bring in 75.2 million. And I don't have an estimate for how much it would bring in if you were to remove it completely and bring it in agricultural assets into line with other assets. In terms of the business relief, dropping it from 90% to 50% would bring in almost 125 million. And looking at the thresholds, increasing or decreasing Category A, that's children, by 50,000, it has a cost or a yield of about 45 million. For Category B, bringing it up or down 5,000 is expensive. It costs you about 19 million to increase it, for example. And then for Category C, bringing it up by 5,000 according to revenue would cost about 7 million. Then in terms of my final slide before passing on to Micheál, I suppose in terms of those reforms to enhance fairness, our view is that all wealth recipients fundamentally should be treated the same, that there should be a modest exemption threshold for everyone, but in our view, that should be below that of median wealth, which in 2023 was 257,000. That'll be a little bit higher in 2025. It's worth noting that property prices in Ireland now are in excess of 380,000. So I don't think there is a clear value that an economist would say this is the amount that it should be. It should be a particular percentage. But I think relating it to median wealth, some percentage of median wealth, is appropriate. Second of all, the special treatments for agriculture and business should really be abolished. There's no obvious rationale for them. They exist, of course, for political economy reasons. We've seen how challenging it's been for government to challenge some of these groups in recent weeks. But it is notable that those particular assets are concentrated amongst the wealthiest households. And then, you know, there are also some arguments that you could have a progressive structure. You could look at long-term payment schedules to deal with cases of households that have very low incomes. And then there is the big question about what you should do on the principal, the primary residence. So with that, I'm going to pass back over to Micheál to make some final observations.
Thanks, Tom. So we've got to that kind of set of reforms that kind of derive from kind of our look at the literature, our look at what's happening in other OECD countries, and then that review of the data and existing tax structure in Ireland, kind of collectively nudging us towards a set of reforms that would enhance, in our view, fairness. So to conclude, I suppose, there's an accumulating amount of data and evidence we really haven't had before in understanding these issues around household wealth and the nature of it, the scale of it, the form that it takes. And that throws up really interesting issues, both of understanding it, but also about planning as we can begin to see if most of that wealth is concentrated in particular assets, that those assets will transfer, or that wealth will transfer over, the next 2 decades or so on. So there's very substantial societal redistribution about to happen, and we should be kind of focused into that. So that, therefore, is an important issue for society, and the paper we're looking at from a social policy perspective, underscores how this is really important in those distributive contexts for understanding the social policy issues around redistribution and so on as well. So we've explored that case for a relatively higher and better designed inheritance tax structure more broadly and specifically for Ireland as a means of addressing wealth inequality, as a means of countering its future concentration, and a means of providing larger, perhaps the better phrase is larger, and recurring sources of additional tax revenue into the future. It's not a silver bullet, it's not going to solve anything, but it's part of broadening the tax base overall. We finished the paper by kind of pointing out that despite the fact the data is relatively new, this sort of space isn't a new space, and so there is a challenge which is not new for groups, organizations, individuals, academics, researchers, and so on, to begin to build a widely accepted narrative around supporting the adoption of these reforms for a better, fairer system where net wealth and its intergenerational transfer can contribute more to the points that we just made for the reasons that we've just made. And that brings us to the end, Paul. So we'll stop there, and we're happy to take some questions.
Okay, fantastic. Thank you for that great presentation. We have a few minutes just to pose some questions, if you have them, to our two presenters here. You can pop up, maybe you could raise your hand. That's just in